Thanks all for being here. I am, as usual, going to go through my state of the nation, so much as it is. And I just have, there's a range of sentiment out there. Most are on one end, which is it's terrible. And then a few are on the other end, which is like, we're super excited. And I experienced that. We were just a bunch of us who were here at the conference with issuers. We were just down in Beaver Creek at a conference, and that was the sentiment there. Most people were, "This is terrible. It can't get any worse. How are we going to, make this work?" And then a few were super excited about the moment. And so I came away thinking about that a lot, and I decided that everybody's right. Isn't that nice? And so that's what I'm going to talk about today. So here we are. Sentiment sucks, except for the few. And I think that this divide kind of captures what's going on, everything about the metals market today, and it helps guide us. It helps us wrap our heads around what to do right now. The fact that both of these feelings exist and are accurate. And I have that chart in there because, of course, it just shows gold versus the U.S. stock market, and it shows how nobody cares about gold, right? The stock market keeps getting bigger, keeps growing in value, and gold is just not participating in that gain at all, right? We're just sticking flat along the bottom. Slight gain there, but nothing to write home about. I don't really need to spend a lot of time on why sentiment is weak. Weak being a gentle word for what we are currently feeling. The main problem is absolutely that just very few investors are interested. I don't think that investors think badly of gold or metals. They're just not interested. And they're not interested because since the great financial crisis, and then way more so since COVID, a whole bunch of other things have done very well, very easily. So conservative investors have just been able to buy index funds. More speculative investors have had a whole range of reasonably new options to play on the speculative end. New things keep cropping up. Of course, AI is the latest, but there's all kinds of offerings in that arena. And so that's kept everyone busy. I also think it's worth noting that it's been over a decade now since we had a really good metals bull market. So there's also a lot of newer investors who just don't know, right? Haven't experienced that, didn't watch tech do that. Obviously, there was a plunge in the middle there, but if you just held through the great financial crisis, they didn't see tech do that. They didn't see the gold companies soar in value. And, ignorance is bliss, I suppose, as in they're not here grinding through the market that we're grinding through. Sorry, that was sort of a knock on all of us. But I think that those are the three sort of main reasons that there's just not a lot of investor interest in our space right now. And I wish I could say this is all going to change tomorrow, but I don't actually think that there is a strong reason that it is going to change tomorrow. Big picture, metal markets move up when two things happen. And this is outside of gold. Gold I will speak to in the next slide. They move up when shortages push metal prices higher. We're not quite there yet. We know that that's coming, but we're not there yet. And speculators notice that happening, and then they pile in. Nope, that's not happening. And like I said, they have all kinds of other options if they want to speculate on things. On top of that, November and December are hardly ever good months in our space, so that's not helping the picture. And metals do well when people are buying into economic growth as an overall thesis, and that's not a certainty at this point. It's far from, right? There's a lot of debate about which way things are going, and these are various charts that just speak to that. Growth is sideways, down, uncertain, because of this intense rate hike cycle and inflation and all of the permutations, macroeconomic things that we have experienced in the last little while. Where does gold sit amongst all of that? Well, with a big fat question mark after it. On the two charts on this slide show different sides of the situation. The top chart shows gold and real rates, which certainly, real rates inverted, I should note, because gold usually is very well correlated at the inverse with real rates. And you can see that, they move together, well, Before 1980, they didn't. But after 1980, they've generally moved well together, except for at the very right side of that slide, you can see that real rates have, of course, gone through the roof, and gold hasn't really reacted yet. So that suggests that there's a risk to the downside. What's going on there? I will get to that in a moment. But then you see the chart on the bottom, which is the premium that the buyers in China are currently paying for gold. Like right now, if you want to buy gold in China, you're going to have to spend $120 over the regular price of gold to get an ounce of it. And that's because there isn't enough there. So I know Chen is going to speak about this quite a bit tomorrow. So, and he has a lot more insight to offer. So I'm excited to listen to that as well. And that's a reminder that gold is the thing that we all know of it as. It's a risk hedge. And right now there's a lot of risk in China, rate cuts, real estate problems, a weak currency, unemployment, a persistent issue, certainly. And all of a sudden that has sparked a flood of interest in gold as a risk hedge. So those are the two sides of it. Like the numbers say that it shouldn't make sense right now, but the reality says that the Chinese are buying it hand over fist. And that's why there's just a question mark there. I don't know. Gold has done very well in the last while, despite what's happened with rates. And let me speak to that a bit more. So yields, right? I think it's worth segmenting the reasons that bond yields have done what they've done over the last 2 years. In 2022, broadly speaking, yields went up strongly because of inflation and rate hikes. So very sort of clear, tangible reasons for rates to go up. Rates were going up, so therefore yields needed to march up alongside, and inflation was part of that equation, and so it goes. This year, when rates are going up, that means that financial conditions are tightening. And the blue line on there, they're both blue lines. That was not a very helpful statement. The light blue line on that chart is financial conditions. So it was getting tighter, which is the light blue line going down in the first box of that chart. Financial conditions were getting tighter in 2022. In 2023, they have not gotten tighter. Yes, we've had some rate hikes, but really, yields in 2023 have gone up because of improving perceptions of the economic setup, that people are getting a rosier outlook, and that's fed into this higher for longer concept for rates, and that has therefore helped bond yields move up and stay up. So they're very different reasons, and I think it's important to note that because that leads to the if-then statements that are at the bottom of the slide. If a buoyant economy with persistent inflation remains the case, that will keep rates high, and so that will keep yields up, and real rates will stay high, and that will be a headwind for gold. But if there is trouble ahead, then yields have a lot of correction ahead of them because of where they stand right now. I don't know which of those is the case. I wish that I did, and you probably all wish that I did as well. That's why I'm supposed to be up here, but I don't know which of those is the case. But it's important to just be aware that those are both possibilities. Okay, so that's all the negative stuff. We don't know what's going on with gold. There's reasons for it to do really well. There's reasons for it to not do really well. For base metals, there's a lot of near-term question marks. And yet, amidst all of this, there's some investors out there who are very, very excited. Okay, so most, like I say, companies and investors in the space have limited patience, right? They have to either raise money fairly soon, if you're on the company side, to be able to function, or they need to be able to see gains in their portfolio or the potential for gains in their portfolio in the reasonably near term to remain engaged, to manage the emotions, to have reason to be invested in this sector. So that majority are despondent. The few investors out there and companies out there who are not under pressure, so that really just means those with very deep pockets, or on the company side with really standout projects that therefore mean they have access to deep pockets, they have the luxury of being able to focus on the big picture, right? And that big picture is something that's been discussed already here. I'm going to run through it quickly. Lack of investments has most metals facing a deficit in the coming years. And I'm going to get to that with a few more charts and coming up here. But that's a very clear and persistent fundamental, I keep hitting this thing, I don't even know what it is, fundamental part of the metals outlook, right? Is that there just isn't enough copper being produced to meet demand over the next little while. Silver, uranium, nickel, zinc, all of them. But that's a big picture thing. It's not going to help our stocks tomorrow. I really don't think it is, but it absolutely is true. And one of the key reasons that supplies are not going to be sufficient to meet demand is because demand keeps going higher, population growth and the green transition. And then there's gold. And gold has a central role to play as the world de-dollarizes, de-globalizes, and absorbs the impacts of an intense rate hike cycle. Those are concepts that I've already touched upon. The successful, I say successful because those who have deep pockets, I assume, are successful, and quite a few of them are investors who have done very well in this space and are coming back into this space specifically to set up for the market that they see down the road. They're really excited, but they are content to wait. Whether this market plays out in 6 months, in 12 months, in 18 months, that doesn't matter too much to them. They just want to be positioned. And I think that's the real takeaway, is that if you want to continue to ride this space, you can't be impatient about it. It's going to come. And it's really hard to say that because I'm an impatient person, believe you me. And I'm tired of the wait because it's been a really long one. It is going to come, but it is not going to come tomorrow. And when it comes, it's going to be a big one. And the reason it's going to be a big one is things like this. I know that this is no words and all charts. I thought I would try that for a change. Sometimes people say I have too many words on my slides. But you can just see the chart top left, the green energy, what the green energy transition is doing to copper demand is pretty next level. I kind of wish that this chart extended further back because you would see that copper demand hasn't changed that much. That blue segment has been pretty consistent. It's just really increased with population since the big growth of China. So it's a pretty consistent thing until we get to see changes like the growth of China, like the green transition, right? And that's where we're at right now, is a dramatic increase in demand for copper. And then you get to the charts on the upper right, which is that we just don't have enough projects. The really steep triangle there shows that back in 2008, you're looking at, there were 60 projects that could produce almost 5 million tons per annum of production capacity, and that had an 80 kiloton per annum average size. Those were in the pipeline. Fast forward 12 years, this is back at 2020, but things have only gotten worse since 2020, and the numbers are cut in half, right? That's what's happened because there hasn't been investment in the space. There just aren't the projects in the pipeline. So demand up, projects that are ready to meet that demand way down, and you sort of put it together and you end up with that chart that you already saw this morning because I stole it from Vizsla Copper because they just had a very nicely drawn image of this supply-demand gap in copper. Okay, over on the gold side, de-dollarization, de-globalization, they're obviously big things. They're very arm-wavy concepts, but they're also really happening on a very tangible level. We are seeing increased accumulation of gold as an alternative reserve asset. Like, these are statements being made on main stages. The move to de-dollarize is not going to help gold stocks. No central bank in the world is ever going to go out and buy even Barrick gold, let alone, small cap junior gold explorer ABC. But they are going to go out and buy a lot of gold. So that is a key reason why the price of gold has been doing quite well. It's just creating a strong base of support. Now, the two charts that I have in here, the reason that I've included them is, yes, you can see that central bank gold purchases are way up, and this chart is even a few months out of date, so that the bar for this year would actually be higher because it's a rolling increase. The other chart I really like because the blue bars are central bank gold purchases that are reported. So the World Gold Council knows who does all the central bank buying. The central banks tell them, we bought this much. So the World Gold Council knows it. But the central banks also say whether the World Gold Council is or is not allowed to disclose the buying that they did. So you can see that it used to be almost all of the buying was disclosed. Most of the bars are blue. As we get to more recent years, there's not a lot of blue buying, so disclosed buying, and there's a whole bunch of undisclosed buying, which is just a lot of countries slowly, quietly, but in a big way, positioning with larger gold reserves for this de-dollarization, deglobalization move. So this is central bank buying. It matters. It's not going to help gold stocks anytime at all, but it is creating a very strong base of support for the gold price. This is I literally just searched, what did I search? Gold, I can't remember, D-dollar or BRICS or something. And these are just a few of the headlines that came up just yesterday about some of the tangible progress on this front. This is a slow thing, right? And the impacts ebb and flow in terms of what they're doing to the price of gold. Right in this moment, for instance, part of what's going on is that we have a strong US dollar, and that is hurting the price of gold. So it doesn't feel like it's helping right now. But the Chinese currency is very weak. And so we have this crazy combined with other reasons for the Chinese to be buying gold. All of a sudden we have gold at a very huge premium in China. The impacts of this ebb and flow, they are not super crystal clear on any given day, but it's an undeniable force. And the overall theme of strong demand for gold from central banks and individuals, like we're seeing in China today, will persist. It will be a very present and ongoing thing as we go through deglobalization and de-dollarization. Okay, cycle settings. Since this is all about the fact that this cycle will turn, has to turn, let's talk a little bit about past cycles. I know history does not repeat, and I am the first to sort of throw aside arguments that are just about, patterns and how they're going to repeat. But what I do like is that since the 1900s, there have been 4 big commodity cycles. 3 involved major inflationary periods, and the 4th was, of course, China's emergence as a member of the World Trade Organization, emergence as a global manufacturing hub, and its own massive construction boom. So where are we at today relative to those characteristics that marked previous commodity price commodity bull markets? Well, we are in a setting of sustained inflation. So I think that inflationary force factor is in play. And I do think that we are seeing a global manufacturing revamp because of deglobalization and the green transition. So I think the pieces are in place. Again, the impacts ebb and flow. They're not unfolding tomorrow, but they're absolutely in place. This is a very similar concept on this chart. The discrepancy here between CapEx going into, or investment going into technology in white and commodities, or it's actually energy, but in red, is very huge, right? And it's just that investors abandoned the commodity space after the last bull market, and they just haven't returned. And there's been other better options for them. And you can't begrudge that. That's just been the reality. But we all know that resource industries require sustained and substantial investments to maintain output, let alone increase output when demand is rising. When investment falls, especially when it disappears for many years, as it has here, then you get these big supply gaps that we keep talking about. These supply gaps are the reason that metals move in cycles. They're very slow cycles. They require all the patience that I was just talking about. But the cycles are, the forces that are moving these cycles, that have moved these cycles in the past, are very present today in their today forms. And that's the message that I wanted to have there. So patience will be rewarded. You don't want to hear that. You want to hear all kinds of convincing arguments that this market is going to turn around tomorrow. I wish I could give those to you. I don't see them. But I do see that this market will turn around and that patience will be rewarded. It's going to take some time, and annoyingly more time than most of us want to give. But those who have done this before in major ways, I keep seeing more of them come back into the space and start setting up their own vehicles, their own major holdings, so that they're ready for this cycle as it evolves. The case study that I just want to give quickly to wrap up here is uranium, right? We're seeing this pattern unfold in uranium right now. You want to talk about long bottoms? That was a long bottom, right? Fukushima was back in 2011. It is now 2023, and we haven't really had any fun in the uranium space ever since. There's been blips, right? But we haven't had a lot of fun. But right now, we are having fun in the uranium space. Primary supplies are essentially gone. That's going to happen, right? Metals markets move up when primary supplies are gone. That's happening in uranium. The 2 largest producers in the world, Cameco and Kazatomprom, have no supply available to contract until 2028. That is not normal. That hasn't happened for a long time, but they don't have it. Politics is powering this market. We certainly have an east-west divide that is increasing. Kazatomprom's product is essentially only going east and will only go east from now on, for all kinds of reasons to do with Russia and Ukraine and port availability, and also just the geopolitics of a strategic commodity. Then in response, of course, there's been a very inward-looking U.S. strategic focus on uranium. Small trading volumes are now creating big moves in the spot price. You can see how much the spot price moved up just in the last few months, 30% up since April, and stocks are levering that move. The spot price is up 30%, Cameco is up 60%. That's what you want to see in a real market. And this is all happening even though we are not in a metals bull market. It's happening because the fundamentals make sense. The fundamentals mean that it is time for these things to happen. So that's the case study for what's going to happen. I am excited for that when it transpires. I certainly own lots of exposure to copper, to silver, to nickel, to gold for when this happens in larger companies that I think will provide fantastic leverage to those moves when they happen. In the near term, I have to lean on discoveries because they are the only things that I think are going to provide pop or profit excitement in the near term, because I don't think that this market is going to provide that in a big way. I think we need to find it on an issuer level. And so discoveries are always the hardest bets to make, right? It's always hardest to find the stock that makes the discovery. But if you can, these are all stocks that have done the three that are narrow are all share price charts. That for some reason was very difficult to say, from the last 6 weeks. So these things are happening and they're big moves. Snowline is, that's a 2-year chart, I think. Discoveries still matter. Discoveries still make a lot of profit. So that's where my focus is for the near term. And I maintain my exposure for the big picture for when it comes around. I think most people here know what I do. I write a newsletter about what I'm buying, selling, and thinking in the metals and mining space. That's my weekly Maven letter. For anybody who's interested in financings, I also provide accredited investors access to financings that I am buying. And I co-write an evergreen investing newsletter with my friend Peter.